The Federal Reserve has just made a monumental announcement, a significant interest rate cut.
That's right. We've got Graham Stephan here to help us unpack what this means for the economy and your investments. Stay tuned as we delve into how this major shift could impact the housing market and what strategies homebuyers should consider.
Welcome to Financial Insights in Minutes, where we summarize the top news from the world of finance. Our framework combines expert analysis with advanced AI, crafting summaries that save you time.
Absolutely. With insights from industry leaders, we bring you the key points from hours of analysis in bite-sized segments. Stay tuned for warnings about the housing market and how to navigate potential challenges ahead.
Let's navigate the waters of today's economy together. The Federal Reserve has made headlines with a pivotal interest rate cut for the first time since March of 2020.
Exactly. Graham breaks down how this decision indicates a new direction for the economy and what it means for stocks, housing prices, and personal savings. So what caused this sudden shift?
Now, let's dive deeper. What's at the heart of the Fed's decision?
Essentially, this rate cut implies that the Fed believes inflation is stabilizing. Lower rates could revitalize the economy, but they also raise questions about the future.
What key economic indicators led to this rate cut?
Recent inflation figures provide some hope, showing only a 2% increase recently, prompting the Fed to act to ensure maximum employment.
And how might the stock market react to these cuts?
It's complicated. The market often reacts to expectations, and history shows that rate cuts can lead to declines, especially if they suggest underlying economic trouble.
What does this mean for homebuyers and the housing market?
There's a potential boost in demand as buyers look to capitalize on lower rates. However, many remain cautious, resulting in slight declines in prices.
Let's discuss predictions. What do experts foresee regarding future rate cuts?
Analysts suggest that further cuts are likely as the Fed looks to stimulate the job market and maintain economic stability.
And what about potential sell-offs in the market?
It's certainly possible. The market could react negatively if cuts are interpreted as signs of deeper economic issues.
So, what should we take away from this monumental shift?
Ultimately, this underscores the importance of a strategic approach where both inflation and employment can be managed effectively moving forward.
As we wrap up this segment, what's crucial is remaining informed and adaptable in these ever-changing economic tides.
Absolutely. The landscape is shifting, and being prepared for change is key. What do you think the Fed's next move will be? Let's discuss.
As we navigate today's currents, let's explore the implications of the Fed's recent interest rate cut.
Absolutely. We're diving deep into the actions of the Fed and their historical significance. Considering that 10 out of the last 14 rate cuts preceded a recession, you won't want to miss this.
What are experts saying about this recent cut?
This decisive action indicates that both the economy and the housing market could experience substantial shifts in the coming months. Historically, such cuts often foreshadow recessionary periods.
What historical trends should we consider?
A major takeaway is that 10 of the last 14 rate cuts led to a recession. The rate cuts in 2007 also sparked brief optimism before the downturn that followed.
How are mortgage rates affected?
Despite a drop to 6.1%, enthusiasm to buy appears lukewarm. An overwhelming 91% of surveyed consumers indicated they wouldn't buy now.
What do current economic indicators reveal?
Data presents concerning trends: retail sales down by 0.5%, and a worrisome personal savings rate of 2.9%, definitely signs of economic distress.
What predictions surround this economic downturn?
Experts predict a recession may be on the horizon in the next 3 to 6 months, especially with persistently low buyer interest. Challenges surrounding inflation could stymie any chance of recovery.
And how do interest rate projections look?
Analysts suggest that additional rate cuts are foreseeable, with predictions indicating mortgage rates may dip below 6%. Yet ongoing weak demand raises their efficacy into question.
In closing, what's the big picture?
Relying too heavily on rate cuts may signify deeper troubles. A hesitant consumer base could lead to a lackluster economic rebound.
Let's leave viewers with a question. What does this mean for potential homebuyers?
Absolutely. Those looking to invest may need to brace themselves for more volatility. Feedback from our audience will be crucial in understanding field sentiments.
Dive in with us. The housing market is revealing troubling trends as home prices and affordability fluctuate. We welcome Lance Lambert, an insightful financial journalist, to share his expertise.
Absolutely. With over a decade of experience, Lance has extensively covered housing and real estate, providing valuable insights into what's happening in the market.
What core issue is at play here?
Lance highlights an unhealthy and constrained housing market. Home prices have hit record highs compared to income levels, leading to a concerning lack of affordability.
How did home prices surge so dramatically?
Over just a year and a half, the market saw a staggering 43% increase. Rising interest rates have caused affordability to plummet, putting pressure on the market.
What role has the Fed played?
The Fed's delay in action as home prices soared resulted in rates becoming uncontrollable. Now there's an urgent push for price stability as the market feels the effects.
Is the housing market uniform?
Certainly not. Regional dynamics vary greatly. Some areas are experiencing a spike in listings, causing prices to adjust downward, while others remain constrained, keeping prices elevated.
What does Lance predict for home prices moving forward?
He anticipates potential declines as new inventory comes on the market. Softening demand could lead to significant price adjustments.
What are the expectations regarding future actions from the Fed?
Speculation abounds that the Fed may cut rates again if conditions worsen, but with inflation still above target, it's a precarious situation filled with uncertainty.
What takeaway can potential homebuyers and sellers grasp from this?
Lance emphasizes the importance of buyers considering their long-term plans in this unpredictable market. An evolving landscape necessitates a strategic roadmap for any buying or selling decisions.
And what final advice would Lance give to those considering entering the housing market?
The essence of Lance's advice underscores that knowledge is power. Understanding local market trends and keeping an eye on broader economic forces can help buyers and sellers alike navigate the turbulent waters ahead.
As we wrap up, remember to subscribe for more insights and stay informed as we delve deeper into the implications of these housing trends in our next segment.
And don't forget to engage with us. Like this video if you found it valuable and drop your comments below. We want to hear your thoughts on today's discussion.
Let's jump right into it. Major turbulence is brewing in the job market as Boeing and CISCO announce significant layoffs.
Indeed. Boeing is in the spotlight with massive layoffs triggered by recent strikes and cost-cutting measures. This story extends beyond job cuts. It delves into the wider impact on the aerospace supply chain.
What's the primary concern here?
Boeing's layoffs reflect broader challenges within the aerospace sector, brought on by strikes and reduction in supplier expenditures. CISCO's situation also sheds light on troubling layoffs that arise despite strong revenue figures.
What specifics can we highlight regarding Boeing?
Boeing is temporarily laying off essential employees in critical engineering roles. This economic move raises alarms about future aircraft safety.
And what about CISCO's situation?
CISCO is laying off thousands while showcasing record profits, a classic tale of cost-cutting measures aimed at appeasing shareholders, raising the question of alignment between layoffs and robust financial performance.
How could this influence the overall economy?
Boeing's layoffs may send ripples through the supply chain, impacting thousands of additional jobs. This could hurt consumer confidence and spending.
What does the outlook hold for these companies?
Boeing may see additional layoffs without stabilization in production. The interconnected supplier network could suffer similarly, affecting the job market as a whole.
Are we looking at an increase in automation?
Absolutely. Companies under pressure to stay profitable may increasingly turn to automation to replace laid-off workers, significantly altering the job landscape.
What can we infer from the current narrative?
The challenges at Boeing and CISCO highlight the vulnerability of corporate America, underscoring the urgent need for awareness regarding economic health and corporate accountability. It stresses the importance of challenging the status quo to enhance job security.
In short, what does this mean for employees?
Employees must remain vigilant about corporate messaging and outcomes. Financial strategies must consider the well-being of human capital, or we could see more tumult ahead.
Let's jump in. A pressing question looms. Is the economy truly on the brink of collapse? In this insightful summary, we'll break down alarming trends making economists uneasy.
Absolutely. Ken McElroy examines unsettling indicators, including rising unemployment rates and increasing credit card debt, key markers pointing toward a potential economic downturn.
What's the core argument in Ken's message?
Ken argues we are witnessing a dangerous uptick in unemployment and debt that, when coupled with soaring inflation, poses a significant recession risk.
Let's explore the rising unemployment rates. What numbers have emerged?
Unemployment has climbed from 3.6% in 2019 to 4.4% today. This shift signifies millions confronting job insecurity.
What do we see concerning consumer debt?
It's quite troubling. Household credit card debt is escalating, pushing many toward food stamps and welfare as they struggle to make ends meet.
How's the job market faring?
Job creation has now hit the slowest pace since 2005, with rising layoffs signaling contraction across major sectors.
Let's discuss inflation, which has been a hot topic. What's the current situation?
Inflation alarmingly stands at 18% since the pandemic's onset, resulting in daily reductions in purchasing power for families.
What predictions does Ken make concerning the economy?
According to Ken, further layoffs may occur as companies tighten budgets amid declining consumer spending.
What about consumer spending?
If unemployment continues to rise, consumer confidence is likely to dip, leading to reduced spending. This economic spiral could complicate recovery efforts.
As we wrap up, what's the main takeaway?
The interconnected issues of rising unemployment and increasing debt suggest we may indeed be heading toward an economic downturn. Keeping a sharp eye on further developments is essential.
How should people prepare for this situation?
Ken advocates for proactive financial strategies to mitigate risks and stay afloat during uncertain economic times. It's all about keeping your financial health in check.
As we close this chapter, we want to hear from you. What financial trends are you observing?
Let us know in the comments. Engage with these pressing issues as we navigate through these turbulent economic waters together.
Today, we dissected insights from various financial experts about the Federal Reserve's recent interest rate cut.
Graham Stephan believes this cut could boost housing demand, but others have raised deeper concerns.
That's true. Reventure Consulting warns that these cuts could foreshadow a recession, presenting a stark contrast to Graham's perspective.
And Lance Lambert highlighted alarming housing trends, while Ken McElroy pointed out possible economic downturns.
As we've seen, navigating this market requires careful consideration and awareness of these expert analyses.
If you found this breakdown helpful, make sure to like and subscribe so you won't miss future insights.
We appreciate you joining us for this insightful discussion, and don't forget to check our other content for more valuable information.